Last Friday was a game changer. We had Israel bombing Iran in a way we've never seen before, the magnitude of that. We've seen a response from Iran to Israel. So far, no energy has been displaced. It has all been about conflict to remove their nuclear capabilities. The oil markets specifically have reacted to that. They've jumped up. There's a big, hefty geopolitical risk premium in that market. But I think the most important thing to realize right now, nothing has happened to the energy complex as of yet. The concern is this expands. Iran uses what it can do to disrupt global oil flows. They have a famous saying, if we can't sell our oil, we don't want anybody to sell their oil. So the biggest risk is a closure of the Strait of Hormuz. 20% of the world's oil flows through that. If we get something like that, even for a week, which we've never had before, but even for a week, that would mechanically send oil prices above $100 a barrel.
What would a Russian and Ukrainian ceasefire do to the commodity market?
Russia-Ukraine isn't obviously talked about as much because of what's happening with Iran and Israel, but let's go through a scenario where we get some sort of resolution. Now, in Europe, Europe is still paying the price pretty heftily for that conflict in the context of much higher natural gas prices, has to import its natural gas via LNG versus what it was getting for cheap for Russia via pipeline. Imagine a situation where we get a resolution and things get a bit practical, let's say in 6 months or a year, and Europe opens up to the idea of potentially bringing in some Russian flows, maybe via Ukraine, for instance, to help in its rebuilding efforts. Why do I focus on Ukraine? There's plenty of pipelines that could come into Europe, but Ukraine has a tolling agreement where it charges for the Russian gas to come into Europe. That is about 2 to 3% of its revenue. If that flow came from Ukraine, that's about 40 BCM, billion cubic meters, out of what Europe consumes on an annual basis, call it 400, so 10%. That would be enough to fill up European gas storage, drop energy prices, and restore some of the manufacturing profitability. However, Europe has become reliant on US natural gas. I would imagine that it wouldn't go down very comfortably with the US administration, that Europe is now shifting from US more expensive LNG to cheaper Russian. So it would have to create a fine balance of bringing in a little bit of Russian gas, but not so much that you don't need any US LNG. But that is something that's on my radar. And I'm hopeful happens just because it alleviates some of the economic pressures here, but it's a fairly sensitive situation.
What are the problems with the rice market in Japan?
This is a very regulated market in Japan where they basically control how much is produced and how much is sold in the market just to have a fine balance. And what's happened is you've had some disruptions in the crop, you've had hoarding by people for fear that rice won't be available, and so consequently there's been a reduction in the supply and hence higher prices. So, commodity markets, let's remember, are all very finely balanced. Supply just about equals demand on any given year. So when you have a disruption like you've had in Asia on the rice side, and you mix in on top of that regulation or trying to control the product flow that sometimes doesn't go right, then that's how we get these issues.
What are your concerns about the tariff war?
Tariffs have created a lot of distortions in commodity markets. So, for example, there's still speculation that there'll be a 25% tariff being imposed on imports of copper into the United States. The United States doesn't have enough copper production to fill what it normally imports. It's about 600,000 tons a year short of what it needs to be self-sufficient. So you impose copper tariffs and you bring that in and you need it, that increases the price of copper. There's about 270 days that you need to study from an emergency security standpoint from the day that you say you might impose these tariffs to the day that they get imposed. So sometime in the fall we'll know if copper tariffs actually go into effect. Meanwhile, what's happened is in an expectation you'll have elevated copper tariffs in the US, copper has moved from the rest of the world to the United States, in anticipation of the tariffs occurring, so that it's already there and you don't have to pay the tariff once it's there. That has caused distortions in prices of copper in London, in China, relative to the US. So tariffs are just generally muddying the waters and creating disruption, and we're seeing it in commodities like copper.
Has the Strategic Petroleum Reserve been misused for political reasons?
Let's remember what a Strategic Petroleum Reserve was set up for. This is set up so you have these reserves in case something happens to global flows of energy that you are reliant on. So countries that are net importers of petroleum products set up these SPR, Strategic Petroleum Reserves. Around the time of 2016, 2017, the US actually became a net exporter of petroleum. It still imports, it refines it, and it exports. Net, the US is a net exporter of energy. Theoretically, it doesn't need an SPR anymore, because it could become self-reliant on what it has and stop exporting if it had to. So the use of the SPR to calm down inflation during the Biden administration was an attempt to squash inflation as you ran up to the election. The problem of doing that is you're basically taking a stock of oil and trying to battle that against the flow of oil from OPEC. It doesn't work. You might reduce prices somewhat at the pump for the average American, but in the short term has a little bit of an effect, but not what you would expect to have. So it's being used for a different reason than actually what you would normally use it for, which is in the case of emergency. So that's really what happened. But the big picture is right now, the US actually doesn't need it.
What impact does the green transition have on commodities?
There's an aspiration to remove ourselves away from dirty hydrocarbons to alternative forms of energy, offshore wind farms, solar panels, and the like. That's incredibly metal intensive. And you need energy to produce that metal to get away from the energy that you're trying to get away from. So the process is kind of bumpy. If you look at what countries are trying to achieve on a country-by-country level around the world, and you add up what does that mean in terms of incremental tonnage of copper, of nickel, etc., and you add that on top of what is currently being consumed for everyday use, building, transmission lines, etc., that means that supply can't keep up with demand as we go forward in time. So that's the reality of the situation, and you're going to need higher prices of metals to incentivize companies to mine more. The problem on the metals complex is you just can't turn on and off mining. These things are 4 or 5 year processes to get up and running. So if you have an aspiration to change the world over the next 5 years, you can't do it as fast as what the market is pricing. So there's a mismatch between what's actually available, what policy wants, and how this is going to transpire.
How are people investing in commodities?
The traditional idea of including commodities in your pension or in an asset management allocation was to provide diversification because they react differently to events outside of what equities and bonds do. And it also, on top of the diversification, gives you inflation protection. Commodities are very highly linked to changes in inflation. Today, people realize there's a lot more opportunity as to how you approach commodities. So commodities are very unique in that they have very distinct forward curves that are very seasonal. So the more sophisticated clients that our bank sees don't just think about commodities from a long-only perspective. They try and extract premia from changes in the curve shape that we saw, for instance, last Friday when Israel attacked Iran. The shape of the forward curve for oil changed dramatically within a day. They don't normally change that quickly, but there's a lot of products that are being built to exploit these changes in curve shapes.
Have retail investors discovered commodity markets?
Retail investing generally we see through ETF flows. What you have seen is a noticeable increase in retail investment in gold ETFs, especially in the last couple of years. Part of the reason is because it's piggybacking on what central banks have started doing, diversifying away from the dollar and buying gold as part of their reserves, which elevates gold prices. Retail investors see this, they want part of that action, and they buy ETFs. But I think the most critical thing that has happened, particularly with gold and a retail investor, is the elevated levels of uncertainty we have today. So there are lots of uncertainty indicators out there: policy uncertainty, trade uncertainty, geopolitical uncertainty. They are all highly elevated. If I plot a line of uncertainty that you can get from a variety of different websites that calculate economic policy uncertainty, you plot against that uncertainty level, which flows into gold ETFs, it's almost 1-to-1. So as long as uncertainty sticks around, you're going to see interest in gold ETFs especially.
How are green commodity products evolving?
The exchanges have been very creative in thinking about how to source metal that comes from sustainable, more sustainable sources. The LME has a thing called the LME passport, where you can track where metals have come from. There's a big demand for this. In recent years, particularly in Europe, there has been a lack of desire to include commodities in your investment portfolios from an asset management standpoint, because they are quote unquote dirty. So that is part of the solution, to say we need commodities to make the world a greener place. We can have commodities in our portfolio that aren't quite as dirty as what they were previously. So the exchanges have been very creative and diligent in sourcing these materials and verifying their credentials.